We weaponize that dollar, and what does the world do? It doesn't trust it anymore. It's a weaponized dollar. You've broken the trust. And what has the world done? They've looked at the dollar differently. They looked at the U.S. Treasury differently. It is no longer a safe Tier 1 asset. It is no longer a strategic reserve asset. And what is the world going to? Well, look at it. It's very simple. Before the war, central banks were buying about 118 tons. After the war, almost double that. Well, frankly, double that, 291 tons, and counting. Why? Because they like to stare at a pet rock because it's shiny? No, because it holds its purchasing power better than anything else, and no, central banks are not stacking crypto either.
Gold prices reached an all-time high of approximately $2,955 per troy ounce on Monday, continuing their upward trajectory amid uncertain U.S. dollar movements. Investors are positioning themselves ahead of a crucial inflation report expected later this week. According to macroeconomic analyst and gold market expert Matthew Piepenburg, the current price of around $2,700 is not excessive when considered in historical and inflationary contexts. Piepenburg argues that gold's strength embarrasses the financial system, particularly the banking sector, which he claims prefers to keep gold out of the public spotlight. Historically recognized as a safe haven asset during periods of global instability, gold's appreciation throughout 2024 has been closely linked to escalating hostilities across multiple regions worldwide. A significant trend Piepenburg highlights is central banks' increasing preference for gold over U.S. treasuries. Following the global financial crisis, central banks purchased an average of 118 tons of gold annually for 12 years, aiming to strengthen financial stability during economic uncertainty and the pandemic's aftermath. A pivotal shift occurred in 2022. While some analysts attribute this change to Russia's invasion of Ukraine on February 24, 2022, the underlying reasons appear more complex. Since 2022, central banks have more than doubled their average gold purchases, increasing from 118 tons per year, 2010 to 2021, to 291 tons per year. This dramatic increase in central bank gold acquisition signals a fundamental shift in global reserve asset preferences, potentially indicating diminishing confidence in traditional reserve currencies and growing concerns about long-term economic stability in an increasingly volatile international environment. Before we begin, subscribe to our channel and click the bell icon to stay updated with our latest content, market insights, and expert analysis on precious metals, economic trends, and global financial developments.
Look at what gold is telling us since we weaponized the U.S. dollar in the wake of the Ukraine war, during the Ukraine war, to sanction Hitler 2.0 because we were saving democracy and Zelensky. Again, we can debate that all day long, but look what central bankers did, because if you had money in Citibank and they froze your account, would you recommend Citibank to anyone? Probably not. John Maynard Keynes said never weaponize a neutral reserve asset, a world reserve currency. Robert Griffin came to Congress in the 60s, said don't go there. Even Barack Obama, don't weaponize the dollar. That was Biden's boss. I don't know who Biden was getting directions from or who was making decisions in the last 4 years, but it wasn't a very smart decision. In fact, it was one of the stupidest decisions in the 248-year history of our foreign policy. We weaponize that dollar, and what does the world do? It doesn't trust it anymore. It's a weaponized dollar. You've broken the trust. And what has the world done? They've looked at the dollar differently. They looked at the U.S. Treasury differently. It is no longer a safe Tier 1 asset. It is no longer a strategic reserve asset. And what is the world going to? Well, look at it. It's very simple. Before the war, central banks were buying about 118 tons. After the war, almost double that. Well, frankly, double that, 291 tons, and counting. Why? Because they like to stare at a pet rock because it's shiny? No, because it holds its purchasing power better than anything else, and no, central banks are not stacking crypto either. I'm not going to get into debate about crypto. It has immense power right now. It's a wolf in sheep's clothing. Digitalization, tokenization means digital ID. Stablecoins, folks, is just central bank digital currency with another name, and that's coming. Nothing you can do about it. And you can profit off the trade. That's another conversation. But the world, the smart money, the central banks of the East, unlike Gordon Brown, who dumped all his gold, he thought it was a good way to make money, and the West won't tell you how much gold they really have. They're stacking gold for a reason. They see the direction of the polo ball. They've been stacking it since 2014. In fact, they've been net stacking it while they're dumping that other Tier 1 asset by the BIS, the U.S. Treasury. They prefer gold over the most important 10-year bond in the world. Why? Because they've lost trust, not only in a weaponized dollar, but they've lost trust in an IOU from an issuer that is literally quantifiably broke. And they don't trust it anymore. That's why we're stacking gold all over the world. And so you look at the gold ball. I got to go backwards. You look at that graph on the Treasury, but some would say, gold's just too expensive. I missed it. I've missed it. It's overpriced. In a bull market, it's topping out. That is a complete fundamental misunderstanding of gold. It's a misunderstanding of inflation. It's a misunderstanding of price moves. It's a misunderstanding of history. Now, no one seems to mind. I'm not here to criticize crypto today, but crypto went to 100% in 60 days. It's $100,000 on its way to $100,000. No one seems to mind that. That's not astounding. Gold at 2,700 seems too expensive. Well, federal debt is up 4,000%. Gold's only up 226%. Since 1980. 226%. We're wondering if it's too expensive. And free money supply is up 1,300%. The median house price in that same period is up 500%. Yet we're talking about gold at 26, 27 range being too expensive. We missed the boat. In fact, in inflation-adjusted terms, gold has over the 20% just to reach its 1980 highs. And when measured against the broad money supply, the M2, gold is as cheap today at 26, 2,700 as it was in the 1970s at less than 50. So now you haven't missed the boat. Gold's not too expensive. And yet that's the talk. RAs, the Registered Investment Industrial Complex, Wall Street, where I come from, gold's too volatile. They don't talk about it because gold is an embarrassment to the system, the banking system, which is a grandchild of the Federal Bank, or the Federal Reserve, which is the twin brother of our government. They don't talk about gold because they don't want you to understand it. It's an embarrassment.
Matthew Piepenburg maintains a robust conviction about gold's upward trajectory, viewing it as a preservation asset and strategic reserve. His outlook on gold's future reflects a profound, almost unsettling certainty about global economic directions. Gold has consistently proven itself an effective hedge against inflation by preserving the asset's real value during rising prices. Unlike fiat currencies, which can lose value when central banks increase money supply, gold's worth remains resilient. This capacity to maintain value during economic turbulence has established gold as an invaluable hedge against uncertainty. Beyond its inflation hedging capabilities, gold is a crucial strategic long-term investment and fundamental component in well-diversified portfolios. Investors who maintain a long-term allocation to gold have historically recognized its value, particularly by capitalizing on its safe haven status during economic instability. Piepenburg's firm conviction aligns with gold's historical performance as both a wealth preservation vehicle and a strategic investment. As global economic uncertainties persist, gold's dual role as a protective asset and strategic reserve strengthens its appeal for investors seeking stability in an increasingly volatile financial landscape. Let's get back to the interview.
I'm seeing a direction with almost scary conviction about where the world is going and where the gold price is going and where the gold as a preservation asset and as a strategic reserve is going. It's not by talking my book. Like I said, I came up during the dot-com era as a stock bond jock in a very supported, Fed-supported lottery ticket market for many years. It wasn't that hard. It was just a rising boat on a rising tide. The market is driven by central bank support, liquidity. Liquidity is the grease and the oil in the engine. As long as it's there, markets will rise. It has nothing to do with how intelligent you are, Wall Street, or what MBA program you came from, or what suit you wear, or what address you have in Manhattan. It's just being at the right place at the right time. It's been supported by the Fed for a generation. A generation that's forgotten what inflation really does, but debt really does, and doesn't really care. So stocks are scary. You can look at all types of indicators in all types of ways. I look at the S&P, the currency in issue, or you can look at the famous Buffett indicator, which is the market cap of the S&P relative to GDP. It's at all-time highs. It's over 200%. By just the forces of gravity alone, we will see the most ignored rule in Wall Street, which is mean reversion, but very weight of that bubble will eventually inevitably collapse when the Fed can no longer sustain this fiction. I can talk about the signals for that for a time afterwards. It's really not that hard. Meanwhile, in the bond market, the so-called risk-free return of the most important treasury bond or government bond in the world, for the last 5 years, when adjusted for inflation, gives you nothing. It gives you a negative return. It's return-free risk. And yet that's the U.S. Treasury, the U.S. 10-year, the Tier 1 asset the Bank of International Settlement asks you to go to for safety. Now, that market ball is followed by another ball, which we can all debate, inflation, deflation. It's not really a debate of either or. It's cyclical. They follow each other. There's all types of conversations now about what's causing inflation. Is it supply shocks? Will Trump's Department of Government Efficiency and layoffs lead to more inflation? Will mass deportation of immigrants be more inflationary? Will tariffs, of course, be more inflationary? We could argue this all day, and it certainly will be inflation, but the rule of cause of inflation is very simple. Inflation comes from debt. Debt is the thing that matters. And you pay for that debt when you don't get it through tax receipts and GDP, productivity, manufacturing. You get it by mouse clicking zeros onto the balance sheet of the Fed and expanding the money supply. And the money supply has gone up 5 times in the last 20 years. That, ladies and gentlemen, is why we have inflation in the U.S. and why other central banks, again, the dog being wagged by the tail of the Fed, has a similar policy. We've had 60 rate cuts in the last year alone by central banks around the world. They're all desperately following the American lead. So when you have inflation, that leads to the next ball that we can see as we're running down that freaking polo field. And that's currency. Currency is a currency risk. When you add a bucket of water to a glass of wine, I've said this so many times, what does it do to the flavor of the wine? It dilutes it. When you add trillions and trillions of fake liquidity, mouse clipped out of thin air, the central bank near you, it's the law of simple common sense that that's going to eventually, over time, dilute the purchasing power of your currency. That inflation, that dilution, as you already feel, regardless of whether it's CPI or PMI or the PCE inflation measurements, which are pure fiction, and everyone on Wall Street knows that. But that inflation, that currency risk, is an invisible tax on you, the sucker for the criminal negligence of your central bankers and policymakers who habitually, chronically, pathologically overpromise and underdeliver, and whatever the delta is to what they promise they can't afford, they pay for with money created out of thin air. And guess what? The one who's paying for that is you. Because inflation is a compounding force. Never underestimate the power of compounding interest or compounding inflation. It is absolutely destructive. Everyone here, regardless of your income, knows this.
Gold has rapidly emerged as a crucial strategic reserve, with central banks significantly increasing their purchases due to the declining trust in traditional financial systems and global currencies. As global dynamics shift and economic uncertainty intensifies, gold remains a reliable store of value. Its growing importance is becoming more apparent, offering a foundation for stability and security in an increasingly volatile and unpredictable financial environment. How do you see the increasing central bank gold purchases shaping the global financial landscape? Let us know in the comments below. If you found this content valuable, give it a thumbs up and subscribe for more insights on gold and the financial markets. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.